Hello everyone, Happy New Year! I know I have said that there will be no video this week, but I decided to rush out one after landing in Singapore on New Year's Day. Anyway, it was a blockbuster year for 2023. S&P 500 hit a 9-week winning streak to end 2023 with 24% gain. Nasdaq was up a whopping 44% in 2023, its best performance since 2003 when stocks rebounded from the burst of dot-com bubble. That's a good 20 years ago. Who would have expected such returns last year? The biggest question of the new year is how will the market fare in 2024? Will the bull run extend into this year? Let's discuss some of the headwinds and tailwinds in this video. Do stay tuned throughout the video, alright? Okay, I will be jumping straight to the technical analysis segment this week because there are lots of things to talk about later in terms of 2024 stock market outlook. Anyway, as usual, starting things off with SPY again. In my previous video, I shared that if SPY holds above 475, we could charge towards 480. A look at the chart shows us that SPY is sitting right at 475. So for this week, the thesis still holds. If SPY can stay above 475, it could still slowly grind up to 480. At 480, I am expecting some sellers to step in as there is one Fibonacci extension level which will act as a resistance. To also note, day by day, the top end of the uptrend channel is getting higher and higher, which gives SPY more buffer to run up before hitting the upper channel. That said, above 480 and before hitting the upper channel, I am expecting sellers to step in at around 486, as that is the critical 161.8 Fibonacci extension level. Alright, so here's the thing to note. I know center rally period is still ongoing till 3rd January to be exact. And I also shared that I was expecting SPY to hit 480 last or this week, but I have spotted some bearish signs based on the current chart. Alright, in case viewers think that I am flipping prata, for overseas viewers it means to flip-flop my words. Do hear me out. I read charts daily and provide weekly updates to viewers, and I am merely presenting what I see. So, if the chart is showing me bullish signs, I will present it to you viewers. But right now, it is showing me bearish signs. I cannot be stubborn to stick to my original thesis. In short, I am delivering what I see on the chart. Therefore, please do not shoot the messenger. Anyway, the first week of January is not over yet, so there is still a chance for SPY to hit 480 by the end of this week. But the probability has dropped as compared to last week. And so here are the bearish signs. First of all, there was a bearish divergence on the RSI, and that has played out last Friday. Then check out that MACD, it just had a bearish cross on Friday as well. To add on, last Friday's mini sell-off came with a solid volume, and it is unusually high for a holiday shortened week. It could be portfolio rebalancing or something by the institutions. We retail investors really wouldn't know the true reasons behind the high volume sell-off on the last trading day of 2023. But when combined with the earlier two bearish signals, they definitely give us good reason to be wary of how the market moved in the first trading week of 2024. I would not chase this rally if I have missed out the last few weeks of strong run-up. Long story short, as per what I have shared at the start of this analysis, watch for the critical support level that I mentioned earlier, which is 475. If it breaks, there's really not much support all the way to 467. If it holds and starts moving higher again, then the bearish signals can be ignored for now. Moving over to Apple, if you could recall, I have identified a strong bearish pattern on Apple's chart in my last video. It's called 3 Black Crows. Since then, Apple continued to stay weak throughout the entire last week. This week, a slightly positive news for the bulls is that Apple seemed to have found support at 191. As you can see from the chart, it hit this 191 Fibonacci level 4 times whenever it retraced, and each and every time it bounced up. This makes 191 a critical support level to watch in the short term. If you want to give and take a little bit, you can throw in the level 189 as well, which was September 2023's high. Bulls need to protect this 189 to 191 area. Then we will have a chance to see a mini reversal from its recent downtrend. Anyway, 6 red candles out of 7 trading days is a rare scene for Apple. The last time we had this was in August 2023, where Apple reported its earnings and had a gap down. that time, Apple fell from 190-ish to 165. Will it happen again this time? We wouldn't know. But in a way, we can make some educated guess by looking at the chart, which in this case, watch for that support zone between 189 to 191. The last line of defense in the short term, which is around these 2 weeks, is the 50 moving average, which sits at 186. If both the support zone and 186 break, Apple will be very bearish. But I think it's quite unlikely for Apple to fall below both support within these 2 weeks, as Apple is reaching oversold level on the RSI. I mean, even back in August when we had that bearish sell-off, it did bounce up a little before heading down again. Okay, here's a wild guess from me, not financial advice, okay? I think these 2 weeks could be a case of Apple gets sold to an oversold level and then bounces up, just in time for earnings at the end of January. From there, the next movement will be very much dependent on its earnings. It will likely determine if Apple can hit 200 or falls back to 180's range or even lower. I am personally waiting for trading opportunity these 2 weeks. If we can get a bounce off the support zone, it could be a chance to sell cash secure put. But I have to emphasize this is not a financial advice. I will provide an update in the options trading segment if I manage to sell any put on Apple this or next week. Before I move over to Tesla, it's appreciation time. A big and huge thank you to these viewers who have contributed to my journey to first paycheck from YouTube. For those who have contributed through my Ko-fi page, a big thank you as well. Just so you know, YouTube takes more cut than Ko-fi, but I also understand sometimes it's easier to just make payment on the same platform, which is YouTube. Whichever the option you choose, a big thank you for your support. Let's see when can we meet the minimum 150 Singapore dollars before I can cash out the money from YouTube. For other viewers who showed your support via liking my videos and subscribing to my channel, I do appreciate your effort as well. It does give me motivation to make more videos this year. Alright, moving over to Tesla's chart. Tesla looks really interesting to me. Remember I talked about 3 black crows bearish pattern on Apple's chart, so you have learned how it looks like, right? Now watch how Tesla moves when the market opens on the first trading day of the year. If we get a third red candle that makes up the 3 black crows pattern, then Tesla's weak momentum could continue. And I think this week's movement will really depend on market's reaction on its delivery numbers. Meanwhile, just to also highlight, there are 3 bearish signals on Tesla's chart since it had that bullish breakout from the downtrend line. First of all, there was a bearish divergence on the RSI, and it did play out last Friday. And given the big fat red candle we had, the weakness could potentially continue into this week. Secondly, last Thursday we had a bearish engulfing candle pattern, also with a decent volume considering it was a holiday shortened week. This was also confirmed by Friday's red candle. The third bearish signal is that the MACD had a bearish cross on Friday. To also highlight, there was quite a fair bit of selling pressure during the first half of the trading day. It seemed like some big players were dumping some shares. Not sure is it someone knows something about the delivery numbers beforehand. Okay, you know sometimes market likes to do the opposite of what we all think. Therefore, as much as I can identify those bearish signals that I saw, and as much as I am leaning bearish for Tesla this week, the delivery numbers can really swing the stock in either direction, which means it can go up also. Once again, I'm not trying to so-called buy an insurance for my bearish thesis. I am presenting the facts on the chart, which are the bearish signals. But that doesn't mean Tesla has to fall. It's all about probability. And to be clear, I am leaning bearish this week. But I'm just a nobody. So let's say if I am wrong, the chart is wrong, or basically the market makers want to go the opposite way, what are the levels to watch to confirm the uptrend? It's actually quite straightforward. Can you see that intersection point between the downtrend line and uptrend line? That's one key support to watch at about 242 level. But given Tesla's high volatility, I would give and take a little by including the Fibonacci level of 240 as well. In short, watch out for 240 to 242 support area. If this holds and Tesla bounces up, that's a classic retrace, retest and bounce up movement. That is also when we can temporarily ignore the earlier bearish signals. In fact, if that happens, ladies and gentlemen, we may potentially break the recent high of 269 in the coming weeks. But let's say 240 to 242 area breaks, watch for 229 to 231. This zone has to hold, I repeat, this zone has to hold because it consists of the 50 and 200 moving averages as well as the short-term strong support level at 231. If this area also breaks, I think we can expect a waterfall down to below 220. Let's now check out Google's chart. Google, please do not tell me you are going back to the consolidation zone of 127 to 139 again. Okay, anyway, if you are trading Google, all I can say is that this week is crucial. For long-term viewers of this channel, you would know that Google has been largely trading between 127 to 139 since July 2023, with a few rare moments where it popped out of this range. As shared in my last video, we need Google to stay above 140 and out of that consolidation range for more than a week to call it bullish. And look at what Google has done. It fell back below 140 again. Yes, I know it's only slightly below 140. I mean, I can cut Google some slack, which is why I say this week is crucial. We would want to see some decisive movement from Google and not closing 0.3 points below 140. Speaking of decisive, last Friday candlestick pattern is called a long-legged doji candlestick, which means there is indecision in the market. So let's see if this week can give us some clearer signals. Anyway, if Google can't stay above 140, that means that the peekaboo at 140 was a false breakout, something similar to October 2023's movement. By adding both up, it's potentially forming a bearish double top pattern, with 127 as the target for the bears because this level is the key support neckline of the double top pattern. Just to reiterate, 127 is very important. It has to hold because other than being the neckline, it is also the bottom of the consolidation zone. If Google indeed falls back to the 127 to 139 consolidation zone and 127 being the target, this could be a trading idea for you. But the caveat is this is not a financial advice and market makers may not bring it down so nicely to exactly 127 for you. And if you are buying puts, be careful of time decay. Okay, basically that's all I can share. Please do your own research before you trade, alright? On the upside, it's quite clear cut. Google needs to get back above 140, stays above it for more than a week, and the best case scenario is to create a new consolidation zone between 140 to 145. Then we could potentially have a breakout towards 150's range. And since we need a bit of consolidation and base building, so it's unlikely that Google will hit 150 this 2 weeks. I think the upcoming earnings in end January or early February is crucial in determining whether Google can finally see 150's range in Q1 2024. Moving over to the options trading section, 3 trades to update this week. The first one is a new covered call that I saw on Tesla on the last trading day of 2023, which was last Friday 29 December. The strike price is $3.15, expiring 9 February 2024. The short version of the rationale behind this trade is that I saw a few bearish signals on Tesla, which I had covered in the technical analysis segment, so please check it out if you happen to have skipped that portion. But to summarize, the bearish signals are bearish divergence on the RSI, bearish engulfing candle, decent volume and pressure in the sell-off, and MACD had a bearish cross. As a result of all this, I decided to sell a cover call, which is a slightly bearish move. That being said, here's a caveat. Tesla is expected to report its delivery numbers around 2nd January. This could swing the trade wildly in either direction, which means the trade could work against me if Tesla rockets up. Actually, it seems like someone knows something and hence the 2 big sell-off days leading up to the numbers. But this is just a wild guess, I could be wrong. And to give myself enough buffer in case I'm wrong, I chose a strike price that is quite far away at $3.15. So why $3.15? As you can see from the chart, $3.15 is where the 161.8 Fibonacci extension level sits, and Tesla has to rally about 26% in order to breach my strike price. That's quite a massive rally by early February. Furthermore, the last time Tesla closed above $3.15 was in May 2022, more than 1.5 years ago. Not saying Tesla cannot do this in the next 1 month or so, but the probability is not high. The second trade to update is this Google cash secure put that expired last Friday 29 December. This contract was sold on 5th December with a strike price of 122. If you have been following me, you will know this trade was a little unconventional one, as the days to expiration was relatively short when compared to my other options trades. The contract was sold on 5th December with about 24 days to expiration. The main reason behind this trade was because I had a covered call with the same strike price of 122 that was expiring on the same day 29 December. But I wasn't living in denial, as I jolly well knew the probability of Google falling below 122 by 29 December is very low. Therefore, I know my covered call trade will not go in my favor. As a result, I thought, why not sell a cash secure put option then to milk extra premium, even if it's just 50 bucks. You can check out the video link at the top for more information about this trade. Anyway, this brings me to the third trade to update, which is that covered call on Google with a strike price of 122 and was expiring 29 December. As mentioned earlier, it was obvious that Google would not fall below 122 by my expiration date, so I decided to roll this option again. I mean, I could let the contract expire and earn a profit of $2,200, as my cost price of this 100 Google shares is $100 per share. But I didn't want to lose out on its additional upside, so I decided to roll the option contract again. For the benefit of newer option traders, rolling of this covered call means that I bought back the contract that I previously sold, and then I sold a new one. A lot of trading apps allow you to do it in just one click. Anyway, yup, I had to roll this contract again. If you have been following me, you will know that I have been rolling this for many months. No hiding of this so-called trade that went wrong. So I managed to roll for credit again. If you are curious, the calculations are shown on the screen. I also managed to increase its strike price to 125. Let's see where Google's price is come February after its earnings report. Alright, the stock market climbed the wall of worry and went against all odds to give investors solid gains in 2023. So many of the so-called experts got their calls or predictions wrong. This simply shows how unpredictable the market is. This also means that we all should try not to predict how the market will move this year. Okay, maybe I should paraphrase my sentence. It's okay to have a prediction, but it should be for the fun of it. The important thing is not to be too fixated on a particular outcome. For instance, a recession, a market crash, etc. I guess this is probably the biggest takeaway of 2023. Anyway, entering 2024, let's discuss some of the headwinds and tailwinds and my thoughts of this year's market outlook. From there, you can form your own views. First of all, the potential tailwinds for the stock market are summarized below. Cooling inflation, rate cuts by the Fed and no recession or soft landing, improved corporate earnings growth, AI industry continues to boom, and the US presidential election. The first one is quite widely expected by the stock market, but don't you find it funny how things have changed? Enter 2023, many people were expecting a recession. Right now, entering 2024, most of us are expecting a soft landing, which means reducing inflation without causing a recession. A hard landing would mean a recession. Anyway, back in December, the Fed has already turned dovish as inflation shows further sign of easing. At the same time, the US economy remains resilient while the hot labor market is also cooling. All these are good news to the Fed. And it's just a matter of time that Fed starts cutting rates in 2024. The real question is when. But whichever the time period, don't fight the Fed, they say. Next, in terms of earnings growth, 2023 saw negative earnings in the first half of the year, followed by improved numbers in the second half. Specifically, S&P 500 reported earnings declines of 1.7% and 4.1% for the first and second quarter of 2023. However, in the third and fourth quarter, earnings grew 4.9% and estimated 2.4% respectively, according to FedSec estimates. I think this is likely to continue into 2024, especially when Fed starts cutting rates, which is a move that generally benefits businesses because the cost of borrowing is cheaper. In addition, if AI continues to boom, it could also help to increase companies' earnings. Which then brings me to the next point. I personally think that AI hype could continue into 2024 as the tech industry and many businesses are ramping up on harnessing AI to help grow their businesses. It's just amazing how AI can streamline many business processes and make work so much more efficient, such as generating content, analyze data, and the list goes on. As things are done more efficiently, businesses grow faster and bring in more revenue, and these are all positive signs for the stock market. The last tailwind is an interesting one. Basically, stocks tend to climb during election years. Since 1952, the S&P 500 has not had a negative year during a presidential re-election year. The only down years were in 1960, 2000 and 2008. These are the years when both parties offered new presidential candidates. Just to add, S&P 500 typically outperforms in presidential election years when the incumbent party wins. So yep, kind of fun fact for everyone, but also a potential tailwind for consideration. In terms of headwinds, basically it's more or less the opposite of the tailwinds. First of all, if inflation takes up again, then the fight against inflation will have to continue, which means interest rates have to remain high, which also means it's bad for businesses as the cost of borrowing is high. To prevent a resurge in inflation, the Fed has to be very careful in making their first rate cut decision. In short, the risk or dilemma that the Fed faces is that they cannot wait too long nor move too quickly. This brings me to the next point. The market is pricing in a rate cut in first half of 2024. In fact, more than 80% are expecting the cut to come in March. So what if the rate cut comes later? The mismatch of the market expectations and Fed's actual decision could potentially be a headwind for the stock market, though it should be a short-lived one. Back to the bigger picture, earlier on we talked about earnings growth. However, if the economy continues to slow down or Fed somehow couldn't achieve a soft landing and a recession comes, then the pressure will be on for the stock market again. Another thing is that we don't know how much the market has priced in the AI hype. Some could be priced in to perfection in my opinion. So if any of the AI related companies do not deliver superb results, there could still be some sell-off. Meanwhile, there are also other uncertainties in terms of geopolitical tensions and the ongoing wars. We really don't know how this will pan out this year, and whether will they affect supply chains, demand of goods, import and export of certain products or technologies, price of commodities, etc. Okay, my personal thoughts are 2024 will likely be a positive year as the current rally is showing signs of broadening out to many sectors. If the macro turns more favorable this year, small cap companies or companies who have left behind in 2023's rally should benefit and have some decent gains. I think the first test of the market for this year will be from end January to around end Feb, where most companies will be reporting their earnings. To add on 31st January, we have the first FOMC meeting of the year. The market will look for further hints of the first rate cut. So yep, this particular 1 month period could be crucial. Beyond that, sorry, I don't have a crystal ball. It's really difficult to do month by month or quarter by quarter analysis at this stage. Meanwhile, as usual, words of caution will be investors should be wary if they are chasing the recent stock market rally into the new year. As mentioned, the stock market has been a little stretched over the last 1 month. The good thing is that we had a little red last Friday, which was welcome. But I personally think it was not significant enough. I mean, S&P 500 has clocked a 9-week winning streak. This streak will definitely come to an end, but we just don't know when. Anyway, all in all, my take is I think 2024 should do okay. It should be a positive year, but not as crazy as 2023. That's all. I'll let viewers know if things change along the way, so do subscribe to stay updated and don't forget to help with the YouTube algorithm by tapping the like and subscribe buttons. Thank you.